There appear to be a growing number of headwinds in the markets at the moment. As we now take a further deeper look at what's happening, we have to ask the question, are markets close to a precipice, or is there a buying opportunity just around the corner that could end up taking us onto new highs for this year? Let's catch up now with our next guest here on IGTV. It's Sankar Sharma. He's the founder of riskrewardreturn.com, and he joined us with a look at some interesting charts today. Sankar, it's a pleasure to have you on today because I know, and I've been following your output on LinkedIn with interest. Just first of all, before we get onto your charts, explain your involvement in the markets.
Thank you so much for having me on your show, Jeremy. I'm really super excited to share with your viewers lots of interesting stuff today. We're going to go through various charts and validate them. Just to quickly introduce myself, my name is Sankar Sharma. I've been in the markets for nearly 33 plus years. Most people might have seen me speak at Society of Technical Analysts, International Federation of Technical Analysts. I've been recently featured on the Authority magazine, and I've spoken internationally, and many of my students have got fantastic results. My company provides investing trading education for aspiring investors and traders so they can manage risks, find opportunities, so in a way that they can grow generational wealth, and also we teach them how to go about, even if they don't know anything about the markets, we handhold them and walk them through various steps. So that's in a nutshell. We provide investing trading education, as well as people interested can hop onto my website and get daily trade alerts and market alerts and things of that nature for free.
Well, let's pick up now, if we can, on some of your ideas where we are now in the markets. As I said, I've been following some of your recent comments with interest, and when we spoke before we went to air on this, we were discussing whether or not the markets are at this inflection point. I wanted to ask you, if you can, just to bring up your first chart, which I know sort of takes a big look at where we are. Explain what's going on and what this tells us.
Jeremy, that's an awesome question because your timing is impeccable with what is happening in the market, with the situation with geopolitical interest rates coming, Fed trying to taper and also increase interest rates globally. Countries are trying to increase the interest rates. So this is a really great question to answer. So I'm going to present this particular Sigma Trends chart here. This gives us quite a bit of insight into where we are, where we're heading, where we're coming from. So let me quickly take you through the various steps in here. In this chart, if you see, we have got different lines. So if I bring the attention of the viewers to the central line, which is like a green channel, and on the outer edge, we have an orange channel, outer side, we got a red channel. So this whole thing, I've been using it over 3 decades, and it just helped me immensely to spot recessionary type situation, key turning points in the markets, and so on and so forth. So what I'm trying to share here is the first piece. If you go back to 2008, we have, whenever we dropped below this middle line, we had a recessionary situation. When it went and touched the bottommost, which is the oversold condition, we had a reversal. So similar things happened in the past multiple times. Every time we came close to the orange line, we had a bounce. Now, a couple of interesting things to observe. This recession here took about nearly 2 years to manifest, whereas our recent pandemic took just a few, less than 2-3 months to manifest. So this is where all the Federal Reserve, Bank of England, everybody around the world has to pump in quite a lot of money. Europe has to do helicopter money and all that stuff. And this is really a point where everyone should focus. If they didn't put the trillions of dollars into the market, we would have had the Great Depression close to 1987. So otherwise, this recession should turn here. And what they've done was immense help to the markets. What happened as a result? The market is being fed with a lot of sweets, cakes after cake, more force fed. So we developed a lot of fat in the market. At this point, if you see here, this itself is like, some people call it bubble, but I call it overbought condition. So if you recall, last year, Jeremy Grantham, one of our British investor, billionaire, he just been saying that the market is going to come. He mentioned that many times in last year, January. Probably follows similar model. This is not a regression chart. This is not a Fibonacci trend chart. This is Sigma trend chart. So this is a monthly chart, and what it is telling us, if you notice the little dotted line, as long as we are above the dotted line, there's nothing stopping this rally, this momentum all the way. So we went all the way this January to super exhaustion level, which is really overbought. Beyond this point, it's dangerous for the market. It needs to correct. And this is where we started the corrective phase. We're now heading back towards the normalcy. Now, this is a monthly chart. This normalcy going back will take quite a few months. Now, this answers two important questions for the viewers. Is there a recession this year? The answer is there is no recession this year for sure, because for recession to happen, we should see price dropping below the midline here going towards the average. But we are too far off. Can we get a bounce? Maybe, but unlikely because of the headwinds we currently have. Even if we have a bounce, it's going to be quite shallow bounce, not as far as it's going up to here. For us to really say this momentum to carry forward beyond this level, we have to cross on all the indices jointly. We have to cross the January highs, which is very unlikely to happen in the coming days. Now that means we are heading down, and most likely we're going towards the 4,000 mark with a little bounce. We may go back into the standard trajectory where we've been going. This is like a normal market behavior. These are all extreme conditions. So there's no expected recession this year, but maybe in 2 years' time.
But maybe in a couple of years' time, yeah. Okay, let's in that case take a step further into the S&P 500 and ask you about some of the key levels to watch out for. As traders, we are very keen on identifying levels which are going to be significant for us to look out for. What are key levels for you as a trader?
I'm going to share some actionable insights rather than talking random. So these are the key points we need to focus. For example, this is a monthly chart from 2008 all the way to current situation. So you can see this curve. If you see, noticed we had a dip. So let's quickly identify the good, bad, and ugly drops that we need to focus on, get the key levels. I marked it with 3 arrows here. So if you've seen, we have done like a 620% gain from 2008 on S&P. So if you get a drop here, the good drop correction could be 18%. We already corrected 10%. So there's another 7 to 8% is on the cards. Now, if you see the bad drop, which is similar to what happened in 2020, if there is a panic situation because of the war or Ukraine situation or anything like that, we may get a 35% drop. But in the most worst scenario, which should not happen, if you have 10 or 7 rate cuts, that could push to a recession fast pace. In that case, we could get a 54 to 58% drop. In this case, it looks 54. So that leaves us with these targets, 3878, 3200, and 2164 to watch. But from what we can see, the most likely drop could be 18%, as we can see in the next chart, which is a daily chart that gives us the possible stop points. Currently, if we breach the 4,200 on S&P, we are looking at 4,000 first stop, 39.52 second, and 38.15 as the next most likely scenario. This is a inverted flag pattern, which most IG traders would be aware of. So that gives us a projected target of 38.15 we should watch out for.
It's interesting you should choose the S&P 500 because the S&P over the last 20 years or so has become fuller with tech stocks. Tech stocks are these growth stocks. Growth stocks are the ones I think that have been most identified as traders as worth selling off. And I think the Nasdaq is probably the best way to look into this. So what's your analysis about the Nasdaq index specifically?
That's a fantastic question, because all these few years, the value took a back seat and growth took the front seat on an autopilot taking off. So you can see I'm sharing a Nasdaq chart going back from 2018 all the way up to now. In this chart, this is a weekly chart. You can see we've been trending, really took off in 2019, and we had a little dip of 30%. We had a correction before 30%, and we took off in a really aggressive way in the top of a portion of the channel. But recently, we've been coming off from the top, losing the momentum in the growth stocks. And this is Nasdaq 100. You can see we come very close to the bottom. If we break this level, we got two levels coming into play, 1300 and in a worst case scenario, 11,730 on Nasdaq 100. If you deep dive quickly onto the lower level time frame to get more precise target, we can see ever since we went below the Ichimoku clouds tell us if the price is above the cloud, it's bullish. If it's gone below, it's bearish, and we are heading towards 1300 on the Nasdaq.
What about the Dow Industrials? As we know, in many people's minds, this is the ultimate US benchmark, but those in the know like to see a broader spread. So the S&P 500 is obviously a better one to look out for. But what about the Dow?
Yeah, Dow, this is the monthly chart going back from 2008 all the way. We had like these two dips here where I marked. And as a technical analyst, we always see if whatever methods we are using, has it worked in the past. So in the marks where I got a little X mark here, it shows exactly these levels came down and stopped at these levels. That means it obeyed the Fibonacci we've taken from 2008 to current levels. That projects us that we're quite likely, if you continue downway, we're going to stop at 30,000 on the Dow Jones in the intermediate term. And if you drill down to daily chart, we got what we traders know as a head and shoulders pattern, which gives us a projected target of close to 30,000. So it confirms what we did on the monthly chart, exactly coinciding, giving a confluence that we're going to get to 30,000 on Dow Jones.
And of course, as traders, one of the other markets we like to look at is volatility. As traders, we do like volatility. We like the opportunity to be able to make sure that we get on a trend, get on a trade. And if these trades do come to pass, as you suggest, obviously short positions across the indices is a good market. And VIX is a good indicator, isn't it, as to how the markets are feeling about volatility. What are your thoughts on the VIX index?
Yeah, that's another great question, Jeremy. VIX, for most part, has been under the cloud, behaving properly, but off late, it's been trying to peak outside the Ichimoku clouds. This giving us a projected target of 30 and 35, which implies that this year we could expect the markets to be quite volatile as the interest rate news comes in, all other things, the geopolitical news and tapers and worldwide GDP contracting. We got a whole lot of headwinds. That suggests that VIX is going to be, the fear index is going to be quite volatile, which means the market is going to be extremely volatile. We should use, as a traders, VIX as a hedge. And that's my suggestion.
Okay, now the next question is, of course, with all this information, is whether or not there are pockets of the market that will outperform others. And it's always interesting to drill down further. You talk about drilling down into some of these indices to get a detailed look on the daily charts to see what's going to happen on the indices themselves. But how about some of the sectors? We were talking earlier about the difference between growth and value, and some of these defensive areas that could well fare better than some of the more aggressive growth areas. In terms of sector analysis, where are you going to take us?
Yeah, I'm going to go through all the 11 sectors of US market. We're just going to quickly walk through different targets and see whether they're bearish and bullish. Here I'm sharing weekly tech sector chart. We can see we have a head and shoulder pattern again showing up similar to what we saw in other things. And this gives us a projected target to the downside. That means if we go inside the cloud, we quite likely go down to further deep down levels based on the projection we get from this pattern. So it looks like currently we're just about on the cloud. We're waiting for this breakout to happen. Should it happen, we can expect this to go down further. If it doesn't, then the pattern will get invalidated. But looking at the situation, it looks like it could go through the cloud and further down to the downside. Here is the financial sector. Financial sector has been really going up for 2021 in the anticipation of interest rate hikes and all that. And currently we are on a pause mode because they haven't seen any move from Fed yet. Once the Fed starts moving interest rates again, we should expect this trend to resume on financials. So financials look bullish because they're above the cloud and they're in an uptrending channel. If you look at the communication, they look really poor in spite of all the noise about 5G. We have gone below the cloud, and also we are heading very fast pace towards the 50% level on the Fibonacci. So communication sector is looking very weak. If you look at consumer staples, this is a very important chart everyone should pay attention to. It's above the cloud. It's heading upwards. It coincides with the big picture we saw on the signal trends that we are entering into early contraction phase in the market cycle. That means normally staples, consumer defense and utility should do well, but this time utility is going down, but consumer staples looks like it's getting ready to break out and resume its uptrend. If it breaks above this level here, I marked in red, we should have a continued uptrend in staples, and that sector looks bullish. And if interest rates comes in, financials looks bullish. Healthcare looks really weak. We're just getting ready to break down. If it goes down, breaks the neck of this head and shoulder pattern, we are going to go down really further down levels below the cloud. If you look at the industrials, it's been sideways for most part of 2021. It now looks like it's already in the cloud and is heading really down. This could be because when interest rates goes up, most of the industrial companies who sell outside US are going to find that it's their margin is going to get crushed. So that kind of indicates in this sector, showing that they could go down further quite a bit deep, because this is, if you take this width and project, they look like they're going to go quite a bit down. Next is the material sector. Currently is come up with what is called flag and pole pattern. We have to break above this red line for us to really get interested in materials. Currently, there's shortage of nickel and aluminum is on the focus. Of course, the gold is the defense play. That is also a hedge for any interest rate hikes as well as any geopolitical issues. So that probably could be citing this move here, but we need to see it breaking above here for us to be really serious about getting involved into material sector. Currently, it is down. Utility sector for most part has resumed its uptrend, but it needs to go above this red line for us to say, okay, utility sector is in play. Currently, it's not in play. Currently, it's just sitting on the bottom line of the channel. Nevertheless, it's above the cloud. Now, consumer discretionary, where Tesla and Apple kind of stocks reside, that is looking a bit bearish as well, with the candle pointing to the downside. It's just entering into the cloud, which means it will go to the bottom of the cloud and probably give a little bit of rest there. So that is looking bearish. And retail sector is, if it breaks this current level, it looks really dangerous. It could go further down very rapid pace. So retail sector is looking very bearish because it's already at the edge of the cloud. If it breaks the cloud, we can only expect it to go down at a very fast pace. So in summary, consumer staples defenses sector looks bullish. If interest rates goes higher, financials look quite interesting. Communication sector and retail sector looks bearish. Health sector looks bearish. And we all have to remember we are in early contraction phase, which means staples, which is consumer defense, should do very well in the coming days.
Okay, so interesting analysis. Let me ask you now whether or not there's any areas of the market that look relatively positive.
Yeah, there are some areas which many people are not paying attention. Those areas include tobacco, aluminum, coal, and nickel. So if you look at tobacco, Philip Morris, British American Tobacco, Alcoa, a lot of coal companies have been doing really well, even though the rest of the market is falling badly. So if you quickly look at Philip Morris, is really in a bullish trend going up. And similarly, British American Tobacco, once it broke above the clouds, has been really racing ahead. Similarly, Alcoa has no stopping. This suggests that Alcoa still got a lot more further upside. People can get involved on a buy on a little pullback here. So in essence, Alcoa, nickel, basically aluminum, nickel, all looking good.
Okay, let me just now run through a couple of other areas of the market that I know are of interest to many traders, and that is gold, but also while we're talking about gold, if you could also touch on oil as well, because two very heavily traded areas of the market. A lot of question marks over where those two charts are going.
If you look at the crude is really on a very uptrend and it's above the clouds. It's heading towards 110 on WTI. So it looks like oil is not going to stop anywhere in near time. It's really on a bullish trend. And if you look at the gold had recently, especially Barrick Gold, if people want to go involved in stocks and shares, Barrick Gold, which is one of them, is really broke out a very aggressive phase. And gold works in two ways. Gold is a hedge against inflation. Gold is also a hedge against geopolitical issues. So maybe that is the reason why gold has been taking off like a rocket. So that looks interesting. With gold, oil going up, with interest rates going up, US dollar could go up. When all three of them go together up, we could expect market to go down. So those levels we talked about could come into play.
Look, it's excellent analysis. Thank you very much indeed. I just have one final question for you. To a degree, it takes us back to the beginning chart. I'm not going to ask you to bring up any more charts, but broadly speaking, how quickly could this sort of price action occur? If you see, let's just take, you came up with three levels for the S&P 500. The mild drop, the mid drop, and then the really deep drop down to those levels not seen since the beginning of our lockdowns in COVID on the S&P. If we do see an extreme drop, how quickly is all this going to happen? Could it all be within this quarter? Are you expecting it to be over by the end of the second quarter? Or is it going to be a long drawn out, slow grind down?
If you look at the charts, what the charts we looked at is monthly, weekly, and daily. We brought it down from top level down. So normally in a situation where there's not too much headwinds, this should happen over a couple of years. The drop I was expecting is not going to happen today, tomorrow. This long drawn out drop. We may get the first 18% drop in this quarter. That is likely. We may see that before middle of this year. As soon as the interest rate starts going up, we could see that drop manifesting itself depending on how fast Fed is going to increase the interest rates. Is directly tied to that. But in general, the bad drop, which we talked about 30+% and the 50+%, it's only in a worse situation where the interest rate goes up really fast and the war situation deteriorates. All that thing happens as a massive panic, and the pandemic returns. And if that kind of scenario, then only that big drop could happen. Otherwise, I don't anticipate it. But generally, that kind of drop happens over a few months' time. At least we are thinking of maybe 2024. If there is any recessionary scenario, it's going to be 2024 based on what charts are telling us. This year, we don't have recession. Yes, the best areas to focus on would be, like I said, staples, financials, and also the tobacco, the nickels, and the aluminum, and the gold. Gold will play defensive position. Also, VIX will all play in part. But to answer your question, it's not going to happen very fast. It's not going to happen today, tomorrow. But those are the levels to watch out so that people can put their money to work when market drops that much. It gives them an extra edge so they can make quick return from their investments when those levels are met. But I don't expect them to happen very fast. There would be slow grind, slow boil.
Sankar, we've got to leave it there, but thank you so much indeed for joining us. And I know I'd love to get back to you later on in the summer, perhaps maybe in the early part of the second half of the year, just to take the temperature of the water, and we can work out where the markets then go from there. But just a quick reminder to everybody, Sankar Sharma is the founder of riskrewardreturn.com, and you can catch up with him on his website. And as ever, of course, don't forget that as traders, we should always make sure that we have measures in place with stop losses, just in case the market turns against us. And these are not recommendations, they're just positionings in the market. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.